I'm Sean Cooper, president and owner of Fit Financial Consulting LLC, a registered investment advisor. The purpose of today's video is to have an open discussion about portfolio analysis, which is really part of my core competency, asset management and investing. But we're really just going to be kind of touching the basics here. My goal is not to bore you with the mathematical matter, subject matter, and minutia of capital asset pricing models, different valuation methodologies, and that sort of thing, although we will have to touch on correlation to help illustrate diversification. The goal is really to help you better understand your current portfolio and how you can potentially improve upon it going forward. So please ask questions, share your ideas with everyone, and make this a learning process. To start off with, I want you to ask yourself a question. How do you view, or how would you define, active versus passive management? Furthermore, how would you relate active and passive management to the usage of ETFs or exchange traded funds versus mutual funds? So take a couple of seconds to think about that. Feel free to pause the video if you'd like. And like I said, ask questions if you're not sure what I'm even asking here. Now that you've had a second to think about that, the way I look at active versus passive management is active management is simply having someone that is making the buy and sell decisions of the underlying securities on your behalf. Passive management simply means that your portfolio is going to remain largely unchanged over time and throughout market cycles, with the possible exception of rebalancing periodically. Furthermore, active management is designed in concept or in theory to attempt to take advantage of mispricings within the market. Passive management, on the other hand, tends to view the market as efficient, and therefore there shouldn't be any mispricing, at least in theory. Those are at least the broad strokes of active versus passive management. Typically speaking, mutual funds are going to be more on the active side. They have an active fund manager overseeing the buy and sell decisions for the fund, with the exception of index funds, which typically track an index. ETFs, or exchange traded funds, are on the opposite side of that spectrum, where like index mutual funds, they typically track an index and therefore don't get modified by an asset manager on a regular basis. We could have an entire discussion about the pluses and minuses and the advantages or disadvantages of active versus passive management, but will suffice to discuss the expenses of each. With an active manager, mutual funds tend to be quite a bit more expensive than their ETF counterparts, predominantly because you're paying for that active manager, that professional, to be able to oversee the portfolio and all of their analysts that work for them. ETFs typically just track an index, which really just requires a group to handle the trading when that index is modified or rebalancing is required. So ETFs tend to be significantly less expensive than mutual funds. I bring up the expenses because, according to a study by Morningstar, one of the only consistent predictors of future returns, and one of the only things that actually exhibits a positive correlation to future returns, is the expense of the underlying fund, or the expense of your portfolio. And you'll find a link to that study here. The second challenge I'd like you to broach in regards to your portfolio is diversification. And to that end, I'd like you to take a look at this grid. And thinking about your current portfolio, check off as many boxes as you feel your current portfolio actually fulfills. So again, feel free to pause the video and take a snapshot of this or write it down and try to see what aspects of your portfolio are actually being represented here. So we're looking at stocks and bonds, both domestic, international, and emerging. Technically, emerging is international, but smaller countries rather, or countries that are still in their development phases. And then I break down stocks by value, blend, and growth, large, medium, and small. That's just market capitalization, and this is whether they're a value company or a growth company. Again, entire subjects can be dedicated to this, but fill it in as best you can. And then with regards to bonds, we want to look at their maturity. So short term, less than a year, 1 to 5 years, longer term or midterm, 5 to 12 years, and long term, 12 to 30 years. And then also their credit rating. So how basically the credit rating is how likely they are to potentially default. So D being a higher risk, AAA being the lowest risk. So fill this out and take a look, see where you have some gaps. The next step would be most likely, and I don't have this in the grid, but a logical next step would be to potentially add alternative investments to your portfolio to further improve the diversification aspects. And really that's the point here, is to evaluate how diversified your portfolio is and get an idea of how you can customize your portfolio to exhibit the risk and return trade-offs that you are looking for. I'm going to emphasize diversification a bit here because it really can be one of the most important aspects of your portfolio. In fact, Harry Markowitz once stated that diversification is the only free lunch. And I'd agree with that to an extent. Certainly by combining multiple asset classes that exhibit low correlation together, you're able to reduce volatility, increase returns, or potentially a combination of those two things. And there's a variety of ways to do that. You can choose individual stocks and individual bonds, the cost there just being the cost of trading those individual securities, or you can more easily do it through the use of ETFs, exchange traded funds, or mutual funds potentially. And again, try to keep them low cost as far as internal expenses go, because that is the cost associated with ETFs and mutual funds, potentially trading cost as well, but predominantly the internal expense ratios. So by utilizing something low cost like an ETF or a low cost mutual fund, you're getting broad diversification and potentially investing in tens or hundreds or thousands of individual stocks and bonds or other securities all at once, which I would say results in a relatively cheap lunch. Maybe not a free lunch, but certainly a cheaper lunch. With that said, what does diversification even look like? Well, think about your workout routine. You want to just do curls day in and day out and not mix in dips, squats, or running or anything else. You'd become unbalanced over time. Your biceps would very rapidly overpower your triceps. Your upper body would become disproportionate to your lower body. The same thing applies in finance or within your portfolio. You don't just want a portfolio entirely of domestic equity. You would have entirely too much concentration and geographic risk to deal with. To get a better idea of what that looks like, consider these pie charts. The first is an average investor's portfolio of about 60% stocks and 40% bonds. The second is a more diversified portfolio consisting of 26% domestic equity, 23% international equity, 21% fixed income, so bonds predominantly, 18% alternative assets, and 12% alternative strategies. Believe it or not, both of these portfolios probably exhibit about the same return or have the same expected return over an extended period of time. The difference is the second portfolio, the more diversified portfolio, has likely lower risk or lower volatility. And when you're looking at this portfolio, I want you to further envision in having each of these slices of pie invested in ETFs or mutual funds or potentially individual stocks and bonds. And then those individual ETFs, say 30 stock ETFs and mutual funds, holding anywhere from tens to thousands of individual stocks, bonds, and other securities. So as you can see, there are varying degrees of diversification. Having lots of asset classes, though, doesn't necessarily mean that your portfolio is going to be diversified. You actually have to make sure that the asset classes you are holding exhibit low correlation. And this is what I was talking about when I said we were going to jump into correlation a little bit to explain diversification. Suffice it to say that correlation between asset classes ranges from +1 or 100% correlated to -1 or 100% negatively correlated. So two asset classes with a positive correlation are going to run in tangent to one another, like this first graph. Asset classes with negative correlation, -1, are going to run exactly opposite of one another, as in this second graph. And then asset classes with no correlation or low correlation are going to have essentially no bearing on one another. What you're looking for is asset classes with low correlation, no correlation, or even negative correlation in order to construct a diversified portfolio. Asset classes that exhibit 100% positive correlation do not help with the diversification in any way, shape, or form. Take an example of stocks and bonds. If stocks and bonds exhibited 100% positive correlation, and we looked at returns, so for bonds, somewhere in the neighborhood of 4.5%, standard deviation of about 3.5%, or all stocks, expected return of around 9% with volatility of about 15%, then you could build a portfolio with these two asset classes anywhere along this red line. So it's essentially a straight line. As you mix the stocks and bonds, your return and your volatility go up simultaneously in link with one another. Now, if stocks and bonds, on the other hand, exhibited 100% negative correlation, you could build a portfolio anywhere along this gray line. Now, as you can see, this gray line actually has a point where it intersects and has a 6% positive annual return with zero risk, no volatility whatsoever. Obviously, this would be an ideal portfolio. This is exactly what you're shooting for. Unfortunately, it doesn't exist. No one, as far as I'm aware, has ever found two asset classes that exhibit perfect negative correlation. If they had, they'd be very, very wealthy, and we'd all know about them. With that said, stocks and bonds do exhibit relatively low correlation. So at the time that I ran this analysis, stocks and bonds had negative correlation of 0.32, which is why you could actually build a portfolio of stocks and bonds anywhere along this blue line. As you can see, anywhere on this blue line is superior to anywhere on the red line because you're effectively increasing returns for the same or even less risk. And that's really what you're shooting for when it comes to diversification. As I said, the goal there was really just to illustrate the concept of correlation in regards to diversification. Obviously, limiting yourself to strictly stocks and bonds is probably not ideal if you're looking to build a truly diversified portfolio, but it does serve to illustrate the point. The issue you may come across when it comes to diversification is correlation does change over time. If you look back to 2008, the correlation between stocks and bonds, for example, actually increased. They moved towards +1 at the exact time when you did not want them to have positive correlation. Their correlation did increase. So what you're looking for are asset classes that are not going to move towards +1 during times of crisis. One that jumps to my mind is something like managed futures, which typically exhibit a correlation with traditional asset classes like stocks and bonds of 0. And in 2008, managed futures correlation to those traditional asset classes actually decreased, moving down to about -0.52. So something to think about when you're evaluating diversification and correlation. The goal here, though, is really just to give you a better grasp of how to diversify your portfolio and how you can utilize these individual asset classes to really tailor the risk and return profile of your portfolio, to really build it so that it suits your individual needs. Or at the very least, I hope these tools or concepts will help you evaluate your current portfolio. If you'd ever like a second set of eyes or someone to provide some guidance on how to custom tailor your portfolio to better suit your needs, by all means, give me a call or shoot me an email. My number is 720-808-6979, and my email is sean.cooper@fitfinancialconsulting.com. Thanks.